Welcome to Within the Frame, where we bring the most pressing issues across the globe into focus. I'm Kim Do-yeon, filling in for Kim Mok-yeon. The U.S. Federal Reserve has cut its benchmark interest rate by 0.25 percentage point, marking its first move toward easing in 9 months. The decision comes amid mounting pressure from the White House and growing signs of a global economic slowdown. With markets now pricing in further cuts, investors are on edge, trying to gauge the future path of the world's largest economy. Meanwhile, the ripple effects are already being felt here in Asia, with volatility in Korean markets and a record-breaking surge in the price of gold. Now, for more on this, we connect with Professor Hwa-kyun Kim, Professor of Banking and Finance at Texas A&M University's Mays Business School. It's a pleasure to have you with us from Texas, Professor.
Always a pleasure.
Now, we're waiting on another Professor Kim, but before that, I would like to start with the basics. The Fed's cut, as we saw, was by a 0.25 percentage points, the first time in 9 months, as I said. How would you read this decision? Does it mark the start of a full easing cycle, or is this more of a one-off adjustment?
As we just read from the media and also from the survey of economic projections from the Fed, I think this is a start of a full easing cycle, because for the last 9 months, there has been no cut. And now I think we start seeing this. And according to the dot plot and also many other, the documents, including the Mr. Powell's own the talk, we can kind of see that we'll try to have more consecutive cuts, at least through the end of this year. And according to the other projections, we're likely to see 2 or 3 more cuts up until like early next year. So I would say this is more like a full easing cycle just began.
Right. And now that the updated dot plot is out, the market sees 2 or even 3 more cuts by year end, like you said. Professor Hwa-kyun Kim, what stood out to you from the Fed's message and projections? Is a path for more easing now clear with the message?
So the current rate now, the target rate of the Fed is now between 4 and 4.25%. So 25 basis point cut. And as we just talked about, like 2 more cuts are likely through the end of this year, which means that it's likely to become like something below 3%, like 4%, so like 3.75%. Or like 3.5% range is likely to be what we will see by the end of this year. And from the dot plots, now we see a little more divergent distribution of like these forecasts of both interest rates and other important economic data such as GDP, unemployment, etc. So I think the key takeaways here seems like compared to the June ones, the dot plot shifts downwards a bit in terms of the interest rates. And also somewhat also slight increase in unemployment rate, and also slightly uptick for the GDP growth in terms of both the mean, median, and also volatility as well. So I think this reflects the Fed concerns about like softening labor market, and despite the persistent inflation, maybe it's time for the Fed actually to react before it's too late about like possible recession and things like that. At the same time, like I just said, despite that persistent core inflation, etc., possibly because of tariff and political pressure and many things, I guess the Fed actually wants to at least justify their cut based on the data, so that it doesn't look too like politically determined and things like that. So I think that's kind of an important takeaway from this meeting.
All right. Before we get to the next question, Professor Kim Yong-jin of Sogang University's Business School is here with us as well. Professor Kim Yong-jin, welcome. I'd like to go straight to a question to you now. As we were speaking about Fed rate cut, President Trump has kept up his pressure until now, calling this week's move even too little too late and demanding a bigger cut. How much of a role do you think politics is playing in the Fed's recent moves?
Well, as everyone knows, in recent weeks, Trump has, moved to fire one member of the Fed Board of Governors and secure Senate confirmation for another, even though that the trial to remove that Fed board was kind of failure. But these both officials are on track to among the 12 policymakers who will cast vote on the interest rate decision. The race to reshape the Fed comes after Trump raised 4 months against the central bank and its chair, Jerome Powell, for rejecting his call for lowering interest rate. In July, Powell stressed the importance of political independence, saying it allows central bankers to make very challenging decisions based on data. So I believe, that the Fed has set interest rate policy independent of the White House, even under the pressure by President Trump to cut the rate for several months. The Fed did not give up, their role as the independent decision maker for the base interest rate. I think this trend will be kept, even though Mr. Trump, appointed his ally, Steve Myron, as a member of Fed, who alone urged a big cut of 0.5%.
Right, and I want to turn to you, Professor Hwang Kim. As we said, we have two Professor Kim, so we're going to have to say your full names. But it's going to be on the same line as Professor Kim just said. I wanted to ask you your thoughts on this as well. So after this decision, is anybody going to question the independence of the Federal Reserve?
I mean, medias will, but to be honest, I don't worry too much about this because this type of the Fed independence or the central bank independence has been like decades-long topic. And there are countries where very explicitly the government is trying to control or at least to give opinions, very strong opinions to the central bank. And others are more subtle and implicit. And the Fed actually was the opposite case where independence is more explicitly stated and then try to establish that. But clearly, I think this administration's a bit different in terms of style. But at the end of the day, I mean, we know the dual mandate and plus some other financial stability as main rules of the Federal Reserve's the decision making. And as compared to 10 years ago or 10 years ago, now I think the statistical tools and the sort of the data presentations to the public and to the finance industry from the Fed is way more sophisticated and much more well sort of econometrically presented. Therefore, it's going to be still largely based on data and data driven, and also the decisions we will see all this dot plots and the over the confidence intervals and things like that. So financial markets gonna make a determination, actually to determine this type of things. And therefore, overall, this time the global reactions to me, I think, is going to be mostly positive, in part because out of this uncertainty and global, the issues, the lower rate, I think, is going to be helpful, at least to ease the financial constraint.
And speaking of being helpful, now I want to bring the focus to South Korea. Professor Kim Yong-jin, who's in Seoul, so I'm going to ask you this question. So it was expected that the rate cut was going to happen, and the KOSPI was on the rise, but it kind of dipped for a little bit, saying that everything was valued in already. But today we saw it just jumped right back up. What do you read this reaction?
Well, it was quite surprising to see that the winning streak for Korean stocks, just came to an abrupt end yesterday, right? This was believed that investors to look to reap profit ahead of the Federal Reserve's rate decision. The benchmark, Korea Composite Stock Price Index on Wednesday, yesterday, fell 36 point to 22 point or 1.05%. To close at 3,413.4, And especially, semiconductor chip shares led, losses after U.S. President Donald Trump hinted that he might impose tariff of higher than the 25% or 100% on chips and a pharmaceutical product. I guess, basically investors sold off shares to, lock in profit ahead of the Federal Reserve's rate setting meeting on Wednesday, where the U.S. Central Bank is widely expected to cut its benchmark interest rate. The means it looks like a breather, after the recent big rally. As we know, today, Korean stock market and Japanese stock market also bounced back, which would be, a natural response to U.S. interest rate cut. The U.S. interest cut will serve as a trigger for the economic growth around the world, and then it will stabilize most of countries' economic situation and financial stability further.
Right. Now, Professor Hwang Kim, I want to talk about the currency as well. The Korean won was volatile throughout the session. Do you expect more capital inflows into emerging markets like Korea, or will investors try to stay defensive?
Well, Korea is not strictly speaking, it's not an emerging market, but I think in terms of currency side, yes, it's more like an emerging market because the currency has not been very stable, and also it's affected a lot by the more exogenous factors. But having said that, I think the capital inflow is more likely, partly because of this interest rate cut, but we also know that the Bank of Korea is probably going to be a little more comfortable cutting the rate for the next meeting or probably in two meetings, because now the Fed is going to lower the cut, and therefore it's going to be a little more comfortable for the Bank of Korea to move, and then a little more flexibility, which is not bad, of course. So I guess it's going to depend on the speed. But if the Bank of Korea can hold one more time, I think, definitely that's going to be more helpful, I think, to already a nice situation of this possible capital inflow. Even if it's not, then it's not going to have too much adverse effects on the currency side. Because it's kind of like going down together, and also the gap is not going to be get widened in that sense. So yeah, I agree that capital inflows is more likely for the time being.
Right, and we're going to stay with investing. Now, here comes million-dollar questions about making money. Professor Kim Yong-jin, globally, there's a major shift for investors. We're talking about flows. Where they put their money, and gold prices have been soaring. Is this about lower interest rates, or is there a deeper flight into safety happening?
Well, I think investors are always smart, right? The gold price has been affected by many factors, including Russia-Ukraine war and changing trade policies of Mr. Trump that negatively influence on inflation and supply chains. The rise in gold prices over the past few months is really down to Trump and what he has done to geopolitics and global trade. This time, the gold price has been lifted by expectations and action of the Fed. The U.S. Central Bank will, cut its key interest rate, making gold an even more attractive prospect, for investors. Moreover, Mr. Trump, has launched a repeated attack on the Federal Reserve's chair, Jerome Powell, like I mentioned, and recently attempted to fire one of his governors, Lisa Cook. The worries of the independence of the U.S. Central Bank, the Federal Reserve, have been grown in the market, which in turn drove renewed interest in safe haven assets, including gold. Probably, the preference to gold will last for a while, due to the safety issues.
Right, and if gold's gonna be profitable for a while, now Professor Hwang Kim, silver also has making a quiet rally, right? And it's outperformed nearly every other asset. Do you think this is also another alternative for investors right now?
I think so. The silver has been quietly delivering the really strong performance among these major commodity slash assets in 2025. And if I recollect actually correctly, it's actually about like 45 to 50% year to date performance. So it's actually kind of outpacing gold. And this is not just a one-time thing, but actually it's a bit historical in that although gold, of course, always like the biggest safe haven and also like ultimate the hedge assets. But if you look at like a historical comparison, the silver has been outperforming gold, especially in really bad times. So usually silver is more volatile because it has more industrial use. It's going to be more sensitive to business cycles. But at the same time, whenever actually the market is really down and then people really need some safe haven assets, like in addition to gold, silver actually, because it has been pressed, it just jumped back actually even higher. So typically showing the bigger performance. So I think, this pattern is going to continue. And obviously gold is limited in terms of supply. Then I think the silver is going to be right next to line. So yes, it's going to be doing good, I think.
Right, now we started with gold and silver, but given all of this, rate cuts, market volatility, safe haven flows. Now, Professor Kim Yong-jin, what kind of portfolio adjustments or strategies make sense right now, especially heading into the fourth quarter?
Well, as Professor Kim Mok-yeon explained very well, this is quite a tough question, or put it, another way, it's very simple questions, right? Because absolutely, the U.S. Treasury bond and U.S. dollar might not be a good choice for the portfolio of investment, because the rate cut may make all other currencies and other assets outside of the U.S. maybe more attractive, especially like gold or real estate or even silver. Or even bitcoins, will be more attractive, due to all that Trump's, policy uncertainty and also the U.S. Fed, rate cut. I think, so investors need to think about the portfolio of those kind of real assets, gold, silver, and bitcoins. And also, they have to diversify their portfolios more because in the volatile, period, the diversity would be very efficient.
Diversity sounds like something that I definitely need to learn. Now, I want to turn to you, Professor Hwagin Kim, as well. A similar question. Now that the Fed has entered an easing cycle, markets are trying to figure out what comes next. What would you highlight as the key risk or opportunity investors should watch most closely in the months ahead?
I think it goes back to like the original questions that you raised in the beginning for today's talk. So I think why interest rate actually is now going into easing cycle based on the Fed decisions. It's because one, I think the softening labor market, so the unemployment risk, and also the uncertainty, both like the trade, actually political, and also just in general, like financial uncertainty. So I think these are the risk factors that the investors have to watch out. So if for the labor market uncertainty and risk, I think it is important to have assets that could be good hedge against potential unemployment risk for investors as well. At the same time, the political ones, I guess, safe haven assets. So like, cash, real estate, like, as Professor Yong-jin Kim mentioned, like, the Bitcoin and all these kind of like the assets that are known to be hedging. And also at the same time, of course, we're talking about the era of AIs and all this kind of big possible growth. It is uncertain, but because of that, you definitely want to have some, the assets that actually can, time the market. So therefore, the big tech stocks and all this kind of like the growing stocks. I think you definitely have to have at least it's kind of the big, barbell type of the hedging that you need, both very growing stocks with the very safe assets.
Now, thank you for your time and insights tonight, Professor Kims.
Hey, thanks for having me.
Thank you.
And that will be all from us on Within the Frame. Be sure to tune in next time as we continue to explore the stories that matter. Until then, stay informed and engaged.